Welcome back. We're finally doing another video in our China series. Alright, this is about Tencent. Tencent is interesting, and I think what caught a lot of people's attention on this is that Monish Pabrai, famous value investor that I think everybody here respects, follows, he sold all of his Alibaba shares to buy Tencent. He did it for tax purposes, and I explained that, I think, in one of my videos, I forget which one. But it's also mentioned in the interview he did with Everything Money where he talked about Tencent. And if you want to know what Tencent does, that's a great video. There are other videos out there talking about exactly what they're responsible for. We're going to focus more on financials here, and I want to show you a neat way that you can value companies, big conglomerate companies, or banks or stuff like that. Alright, so just to give a little bit of overview about Tencent, they are like the social media giant in China, like Facebook, but they're also like a one-stop shop for a lot of social media interaction and entertainment. And then on top of that, they also have a big investment section, so they make a lot of money from investing as well as operating, okay? So companies like that can be really tough to value, which is why I'm going to show you this kind of new method. Let's just look at this price real quick so you can see. This is a 2-year trend. We're down. They were as high as $99 a share about February 2021, and we're down 50%, all right? So if you invested then, you've lost half your money. As always, the question is, has this drop created a huge buying opportunity? So let's check it out. We're going to do it a little bit different here. I don't want to be repetitive and go through the same financial exercise, and it's much tougher for conglomerates. So we're going to run through the financials. I'm going to show you how to do a valuation just strictly on the balance sheet. Okay, so let's start with the income statement. So total revenue's up first. We always like to look at this, make sure it's growing, and yeah, it's definitely growing. You can just follow the trend. This is all in yuan, by the way. This is the Chinese currency. We'll convert to dollars at the end or at some point in the video. Next up, I want to look at pre-tax income. I really like pre-tax income because it doesn't change with tax rates, and it gives you a good view for how the business is done over time when you're comparing apples to apples. All right, and look at this. This is what an exponential graph looks like, all right? So this is awesome. This spike here, I'd like to know, did something fundamentally change and this is the new norm, or is it temporary? It's probably temporary. We're gonna see it again in the earnings per share. And this is one of the problems with valuing, where's earnings per share? Okay, here it is. Yeah, this is one of the problems with valuing conglomerates and companies that make a lot of money from investments is that, U.S. tax law, and you'll see this with Berkshire Hathaway, they have to count their unrealized gains, I'm pretty sure, as income. So let's say Warren Buffett bought Apple stock, okay, and Apple went up. He has to count the amount that it went up as income, even though he didn't really sell any, which is kind of crazy. All right, so in case you don't believe me about that unrealized gains thing, here it is from Warren Buffett himself, all right? He says there's a new GAAP rule imposed in 2018 that requires a company to include in its earnings the net change in unrealized gains and losses in those securities. He says neither he nor Charlie Munger agrees with that. Why do I keep on bringing up Berkshire Hathaway? That's because a lot of people say Tencent is like the Berkshire Hathaway of technology. They've made huge gains in investing in the stock market as well as buying whole companies, just like Berkshire has, but they've focused mainly on technology, not just even China. They've invested a lot in the US, but it's mostly technology companies, and they've got an outstanding return, okay? And you're going to see that once we get to the balance sheet. All right, well, speaking of the balance sheet, that's up next on the outline. All right, so here we go. Total equity. This is how Yahoo Finance calls total equity. They say total equity minus gross minority interest, but they just mean total equity, okay? This is all of your assets minus all your liabilities. Why is this super important? Because this is the net worth of a company, and it is such an easy way to judge companies. It's not the only way to judge and value companies, but for big companies that have a lot of investments, a lot of stuff going on, you want to look at their net worth, right? Because this is a great indicator of what's actually going on with the company, okay? You want to make sure it's rising, and you want to look at the rate it's rising. And this is going to be kind of how we value this company, and I'll show you that in a little while. Okay, but to do that, I want to do total equity per share, right? And so if I just divide, this is total equity. If I divide the total equity by the number of shares, let's see, where is it? Equity per share. Okay, this is still in yuan. I want to go to dollars now. So I have this converted to dollars. Let me pull up total equity per share in dollars and get this back. All right, so here's our total equity per share in dollars. Why is this super important? Because what are you buying whenever you buy a share of a company, right? You're buying equity. So why would you not look at total equity per share over time, right? If you're buying equity in a company, wouldn't you like to see the equity growing, okay? And that's what we see here. That's great. So let me get this number here. It is, what is this, like $14.60, okay? So let me write that down here, $14.60. All right, and lastly, I want to get a growth rate because we're going to use the growth rate to value the company in a little while, okay? So to do the growth rate, I'm going to do kind of like 2 time periods. I'm going to look at a long-term growth, so like over the last, I don't know, 6-7 years, and then one over the last like 2 years, okay? So how do I do that? First, I'm going to do the long one. So I'm going to say around 2015, they were about $2 a share, all right? Now they're $14 a share in 2022. So they went up 7 times in 7 years. 2015 to 2022 is 7 years. So they went from 2 to 14. So they went up 7 times in 7 years. So I raised that to the 1 over 7, and that gets me an annualized growth rate of 32%, okay? That's insane. That is awesome. Okay, so I'm gonna write that down. Okay, so now that I got the long growth rate, I wanna look at their more recent growth rate and make sure that, the high number isn't caused by some crazy rise up in the beginning and they haven't really kept pace. So I'm gonna do this. I'm gonna come over here and say, okay, like right at the beginning of 2020, they were a little over $8 a share, $8.60, okay? Now at the beginning of 2022, they're at $14.60, all right? So what I'm gonna do is I'm gonna say $14.60 divided by $8.60. All right, so they went up 1.697 times, and that's over 2 years. So again, 30%. So they are maintaining that growth rate. Wow. So 30 to 32% growth. That's incredible. All right. Okay, so we're going to use this equity per share to get a valuation. So before I do that, I know you might be thinking, well, equity per share, it's $14. It's selling for, $49 a share. That's a price to book. Let's see, 49 divided by 1460. That's a price to book of like 3.4, right? So it's selling 3 times its net worth. That means it's a bad deal. Not so fast. I want you to imagine this scenario. Let's say I'm going to sell you a bank account. The bank account's got $100,000 in it, and it's going to grow at 26% a year, or better yet, it's got $100,000 in it and it's going to grow at 100% a year. It's going to double every single year. The question is, how much do you pay for that bank account? Are you going to pay more than $100,000? You're damn right, huh? I mean, you're not going to pay $100,000 for that, or I'm not going to sell it to you for that. I'd have to sell it to you for a fair value. So how much over $100,000 should you pay for that account? That's the exercise we're about to go through. There's a lot of algebra, so brace yourself. So we're going to take this equation one side at a time. So on the left side here, this is representing the company that you're buying. So I'm saying you're like after 10 years, what is your book value of the company going to be? So that's going to be your book value times 1 plus growth raised to the number of years. So like to give an example of that, I would say your book value was what? 1460. So 1460 times, that's 1450. 1460 times 1 plus your growth rate, which we're going to use 0.31 because that's 31%, raised to the, let's say, 10 years. All right? So in 10 years, the equity of this company, if it maintains that growth rate of 31%, is going to be $217 a share. That's kind of what the left side of the equation is saying. The right side of the equation has to do with price and your required rate of return. So the right side of the equation says, what price should you pay now, P, at your own required rate of return or your opportunity cost, R, for the same number of years, N, to make this equation match. So I've saved you some trouble. This is that equation solved for P down here. P is equal to this over that. And I've saved even more trouble. I got the calculator's going to do it, or Excel's going to do it. So for book value, I'm going to show you this. We're going to put down 1460, and this is going to be how we get our price target for this stock. So 1460 for the book value. We're going to put a growth rate of 31%. We're going to put 10 years. And what is your required rate of return? You can see if you have a required rate of return of 0, you get that 217 that I got earlier. But let's say your required rate of return is 12%. If your required rate of return is 12% or your opportunity cost is 12%, that means that you should be paying $70 a share for this stock, okay? That's your price target. I'll just do this on the calculator real fast so that, people can follow along. So what I did was 1460 times 1 plus 0.31 raised to the 10 divided by 1 plus 0.12 raised to the 10. 69.96, same thing as 70, right? And real quick, while we're here, I want to show you the 2 variables that affect this the most, okay? It's what future growth rate you expect and what your required rate of return is going to be. So like, let's say you're even more conservative of an investor and you say, you know what, I'm happy with 7%. My required rate of return is 7%. Then you should be paying $110 a share for this stock, all right? But let's say you're super crazy and you're like, no, I only buy things that double every 3 years, so I want 26% return. Well, in that case, you should be waiting till the stock gets to $22 a share to buy. Anyway, that's one way to look at valuing a stock, okay? This is another way that I think is really interesting. It's kind of backwards, but it's how Warren Buffett does it, I'm pretty sure. And I think it's just a really neat way to think about stocks as investments, think of them like bonds, okay? This is the equation inverted to where it's solved for R. So the thought process here is going to be, if I bought the stock right now for what it's selling for, what would my rate of return be at that price? All right, so let me solve this equation. You do 1460 for your book value, B, times 1 plus your growth rate, so 1 plus 0.131. You raise that to your number of years, 10, all right, and then divide by P, which our price right now is $49 a share in US dollars. You raise that to the 1 over 10 and subtract 1. Boom, 0.16. So this would be 16%. So in essence, what this is saying is, if you believe that the growth rate of this company for the next 10 years is going to be 31%, and you bought it right now, you would be almost guaranteeing a 16% return on your money for 10 years, which is pretty good. I mean, it's really good. Of course, all this relies on this growth rate, all right? And that's where your competency on the company comes in, right? If you feel comfortable that they're going to be able to maintain this growth rate, then this is a no-brainer, right? But if you're like me and you're not really sure about all their investments just because you're not familiar with Tencent and you're not familiar with that many Chinese companies, I'm not confident in this 31%. And that's why, I'm not buying the stock, is why I'm not buying a lot of Chinese companies. So. All right, and real quick, watch what happens if I put a 16% here for R. You can see that this equation over here will solve for 49, which is the current share price, right? But remember, like I said before, it rests all on these assumptions. All I can show you is the formulas. The assumptions come from you, and that's what makes great investors. But that's all I got. I hope you enjoyed the video. I hope you learned something. Like and subscribe. I'll see you next time.